Today we delve into the mind of investment maestro Warren Buffett, unveiling his unique insights on what makes a great stock. Prepare for a journey into the world of sustainable competitive advantages. Mr. Jerry McLaughlin from San Mateo, California, addressed Warren Buffett and Mr. Munger, expressing his gratitude for their valuable insights through annual reports, letters, and conversations. He then raised a query about Buffett's idea of economic moats, understanding them as sustainable competitive advantages. He inquired whether businesses are born with these advantages or they need to be developed over a long time. Further, he asked about the fundamental basis upon which companies successfully develop these sustainable competitive advantages. He also sought Buffett's opinion on which advantage was the most enduring and which was the least. In response, Buffett observed that sometimes these advantages can be developed quite rapidly. Microsoft's operating system was cited as an example of this, having been developed relatively quickly in a rapidly growing and changing industry. Warren Buffett continued his discussion on the concepts of economic moats, or sustainable competitive advantages. He offered See's Candy as an example of a business that took decades to develop its sustainable competitive advantage. Since its inception in 1921, the company built its reputation and customer loyalty one shop at a time, a process that could not be hastened due to the nature of its product. A box of chocolates typically purchased a few times a year for special occasions. He emphasized that the pace of developing a sustainable competitive advantage often depends on the nature of the industry. For instance, Walmart managed to establish a significant competitive advantage relatively quickly. Yet this was a gradual process as the company expanded from small towns and refined its business strategies. Buffett noted that nascent industries often present opportunities for companies to establish a competitive advantage in a relatively short period. He cited NetJets, a firm launched in the budding private aviation industry in 1986, as a prime example of a company that had successfully carved out a sustainable competitive advantage. Buffett also discussed the story of Coca-Cola, which started in 1886 in Atlanta, Georgia. The company's founder, John Pemberton, came up with a valuable product, but the sustainability of his competitive advantage at that time was questionable, considering he sold the company for a mere $2,000. However, Buffett further detailed how Coca-Cola's strategic expansion during World War II, upon request from General Eisenhower, had a profound impact on the brand's global recognition and enduring competitive advantage. This highlights the importance of recognizing and cultivating a competitive advantage when one arises. Furthermore, he acknowledged that not all competitive advantages are built over decades. For instance, Walt Disney managed to create a significant advantage fairly quickly in the realm of animated feature-length films, after the success of Snow White and several subsequent movies. Expanding on the idea of economic moats, one might consider the role of innovation in developing these advantages. Companies like Microsoft and Walt Disney, both mentioned in Buffett's discussion, are examples of organizations that used innovation to create an economic moat. Microsoft's operating system and Walt Disney's animated feature-length films were both groundbreaking in their respective industries. Through their unique offerings, they managed to carve out a space for themselves in the market, a space that competitors found hard to penetrate. This innovation-driven moat can provide a significant advantage in rapidly evolving industries, but it also demands constant attention and continuous innovation to maintain. However, Buffett warned that while there are many models for creating a sustainable competitive advantage, some can also quickly lose it. He cited the demise of Arthur Andersen's reputation, juxtaposing it with the more resilient reputation of Wrigley's gum. Buffett also mentioned the case of Snickers, which had managed to maintain its position as the leading candy bar for several decades. He highlighted the challenge of displacing such well-established brands, hypothesizing that Snickers will likely continue to dominate its market in the foreseeable future. He explained that people tend not to experiment with certain products once they find one they're satisfied with, which helps these brands maintain their market position. Buffett's mention of companies such as Snickers and Wrigley's that maintain their market position due to customers' reluctance to experiment once they find a satisfactory product, brings to the fore the role of brand loyalty in building economic moats. These brands have developed a deep relationship with their customers over time, which has become a significant competitive advantage. This brand loyalty isn't built overnight, but is the result of consistent product quality, positive customer experiences, and effective marketing strategies over years, even decades. It serves as a formidable barrier to entry for new competitors, as they not only have to offer a competitive product, they also need to sway a loyal customer base. Thus, when evaluating a company from an investment perspective, one should consider not only its current market position, but also the strength and depth of its customer relationships. His commentary provided an insightful look into the different trajectories businesses might follow in their pursuit of developing and maintaining a sustainable competitive advantage. When Warren Buffett expressed agreement with the notion that great investors are made, not born, he suggested that one's ability to detach oneself from the crowd, although it's uncertain if it's innate or learned, is a crucial quality for successful investing. He further emphasized that having a high IQ is not a requirement for success in the investment world. He went on to recount his own early days in investing, admitting he struggled until he encountered the works of Benjamin Graham. He read every investment book he could get his hands on, but didn't start to do well until after he read Graham's book during his time at the University of Nebraska. According to Buffett, Graham's teachings fundamentally changed his view of investing by encouraging him to see a stock as part of a business. Buffett has often noted the importance of intrinsic value in his investment decisions. Intrinsic value refers to the perceived or calculated value of a company, including tangible and intangible factors, as opposed to its current market price. This is what guides Buffett when he talks about seeing a stock as part of a business. One could argue that a company's sustainable competitive advantage, or economic moat, contributes significantly to its intrinsic value. By building a moat around their business, companies can protect and grow their intrinsic value, which in turn attracts discerning investors like Buffett. Looking beyond the stock price and into the underlying business becomes a critical factor in long-term investing success. This approach, he said, might seem obvious, but he likened it to the Rosetta Stone, asserting that it laid the foundation for rational thinking about investing. Buffett concluded by reiterating that there is no need for a high IQ to adopt this mindset and to become a successful investor. Warren Buffett was heard conveying his thoughts, diving into a level of profound generality. He postulated that a deep-rooted curiosity, a yearning to understand the reason behind occurrences, aids in comprehending the world better. He believed this mindset, held persistently, incrementally enhances one's ability to handle reality. Conversely, lacking such a perspective, he predicted, is possibly a pathway to failure, even for those with high IQs. He stated that they had observed a relatively weak correlation between investment outcomes and IQ. He clarified that it's not that those with low IQs are consistently delivering exceptional results, but it's evident that numerous high IQ individuals don't achieve much. In his opinion, it's intriguing to study why high IQ individuals don't succeed and examine if those factors could be eliminated in oneself. He related it to Charlie's saying about wanting to know where he's going to die, so he never goes there. If you study financial failures, especially among the high IQ individuals, and understand why they fail, certain prevalent characteristics would emerge. Reflecting on Buffett's comments about high IQ individuals not always succeeding in investment, it's worth examining the emotional aspect of investing. As much as investing can seem like a numbers game, it's also deeply tied to human psychology. The stock market isn't driven by numbers alone, but also by the collective fear and greed of its participants. High IQ individuals may excel at understanding the technicalities of the market, but if they can't control their emotional responses to market fluctuations, their IQ advantage becomes meaningless. This may explain why many high IQ individuals underperform in the market. It reinforces Buffett's point that investing success is not merely about intelligence, but also about temperament and emotional discipline. He concluded by emphasizing the importance of self-awareness and management. If you possess these characteristics, he argued, you should either ensure they are not present in you, or, if they are, that you have the ability to control or eliminate them. So, what are your thoughts on Warren Buffett's investment principles? Can you identify any economic moats in your own portfolio? We'd love to hear your insights. Please share in the comments below.